Hello and welcome to this monthly video. I'm making this after probably 3 months or 4 months. I think, if I remember correctly, the last one I did was in March. So, I'm doing this after a gap of 3 months. And you might have been, watching my media interviews, and I've been very, very positive on the Indian markets. And that is practically the main reason why I have not been writing as frequently to you all, or I've not been doing these videos because I wanted to spend most of the time actually going through the different companies that I've been following, looking at corporate results, turning as many stones as possible to look for opportunities. And I'm going to also change the format for this monthly video that I've been doing because previously I was doing mostly Q&A. I'll keep those Q&A if I get good questions. But in general, what I'm seeing is the questions have become very repetitive, and I do these videos, also from the perspective of you know something that intrigues me or interests me as well. So there's no fun in saying the same thing over and over again. And so the point is that what I'll try and do is I'll try to keep doing things which interest me, or and I'm assuming and I'm hoping that those would interest you as well, and you would find some value out of it. So this month, I thought I will talk about what we are seeing in the world around us in terms of investing. And as we go along, I'll keep changing the format, or seeing how things look. Hopefully I'll try to do a little bit more going forward. Luckily, for the last, I think, couple of months, both I mean, IntelSense, the services have been doing performing quite well. Also, the PMS funds have been doing extremely well. I think Quiver, which is our small case offering, has done phenomenally well. It's been consistently in the top 10 amongst all small cases over the last 1 year. Last couple of months have been spectacular. Not that I'm very keen on looking at short-term results, because in my opinion, that very short-term results are skewed more towards the luck skill, toward more towards luck than skill. But consistently being able to do well over a 3, 5, 10 year period is what we are looking at. And I think that's the key objective or key goal that I always have in terms of investing. So let's look at one of the key questions that would come up in anybody's mind today, which is the markets are at an all-time high, it continues to go up. So what do we do now? Should we book profits, or should we stay fully invested? Right. So here is the chart, monthly log chart. Why log? Why monthly? Simply because monthly will show you a very long term duration. Here I've tried to look at it from the beginning of Nifty, which is 1991. And log chart is because if you are looking at a very long period of time, logarithmic charts will give you a better representation. Otherwise, I mean, if you take a normal chart, what happens is the current performance tends to overshadow the overall performance. So here, if you see, uh, Nifty, if I look at Nifty as a representative of the overall market, you will see that from 1991 uh, till today, markets have been on an upward trend, although we've seen sharp downturns uh, from time to time, right? I mean, there's no question that markets are non-linear. They will not go up or down in a linear manner. It will, keep oscillating. It will keep going up and down, and that's the nature of the market. But over time, over a few year period, markets tend to go up, and that is what is the most important takeaway for all of us who are investors. And if you look at studies, across global markets, you will find that if you invest with a 1 year horizon, approximately 33% of the time you have a probability of losing money, right? So 1 in 3 years, you might end up losing money. If you invest with a 5 year horizon, what happens is, which basically means that if you invest and hold for 5 years on a rolling basis, what we found is there's an approximately 8% probability of losing money, right? 8 times out of 100, you will end up losing money if you remain invested for 5 years. Now, if you stretch your time horizon to 10 years, 3% of the time, so 3 years out of 100, you will, or 3 times out of those 100, years, you will end up losing money. But if you invest with a 15-year horizon, there's approximately 0% probability of losing money. Now, this is historically based. It doesn't mean that it will be so in the future. We've again enough examples globally to show that there are instances where people have lost money over extended periods of time as well. Case in point being Japan. But in general, in a growing economy like India, it is very, very unlikely that we will lose money as investors if we invest in reasonably chosen stocks or even the index over 10-15 year investment horizon. So this is something that we need to keep in mind even when we are investing at perceived all-time highs. Okay. Uh, what is more important to understand is that you can never invest yesterday, right? It will always be that if you look back and think and feel that, okay, COVID, I should have invested in during the COVID times, I should have invested when the global financial crisis hit, or things like that. It can never happen that you can go back in time and invest. So the best time to invest for the next 10, 15, 20, 30 years is today. And that is something that I always keep saying to everyone, especially people who are young, people who are just starting their careers. Save a little bit of money, maybe 10%, 20%, 30% of your salaries, or your business income, whatever it may be, and start investing in equities, because over time that will give you the greatest amount of returns. With that, let me move on to the way I see what is happening around us in the overall markets and the overall economy, and how we are positioned as a country and as an economy, as in a market. Okay, so first and foremost, I think what is important to see is that India, as a country, is beginning to emerge out of its own shadow. Uh, if you see the global news flow, newspapers, I read, the Financial Times and the Wall Street Journal, and I've been reading them for a few years. This is the first time I'm seeing a lot of coverage about India, and I'll talk about it a little bit later. So there is a sweet spot that we are seeing. If you see, FII inflows have started picking up significantly. uh, there's this trend that you can see, right? Over the years, we've picked up significantly. 2023 already, we are probably middle of the year, and very, very good numbers already. The other important thing is that mutual funds, domestic mutual funds, which is retail money from people who are small investors, retail investors, uh, that has been very, very strong. And uh, the most important thing is SIPs have been very, very strong, and I think that's a very, very good indicator for India as well. Just to take a random fact out, what I saw is that investments in equity mutual funds are right now uh, more than what the government of India had budgeted for capital expenditure. Now, that is not a small thing. That's a very, very big thing. Government of India's total annual capex budget is being surpassed by the inflows into or the investments in equity mutual funds. And if you look at the spread and the breakup of investors, you will see that the opportunity size or opportunity is still there. I mean, it's not saturated by any means the education of the financial education, financial inclusion is slowly happening. These things take time, but I am very positive that over, if you look at it in blocks of 5 year horizons, so 5 year time frames. So if you're standing here in 2023, maybe if you look at 2028 and 2032, 33, we will find that these numbers are going to be consistently going up, which augurs very well for the country. The next thing, again, that I keep tweeting about or talking about, if you see, is how manufacturing is shifting from China to a lot of other countries following the China plus one theme. Now, by no means am I saying that India is going to be the uh, biggest beneficiary, or India is going to be the only beneficiary. In fact, India may not be the biggest beneficiary at all. Probably the biggest beneficiary uh, for migration of manufacturing out of China is probably going to be Mexico, because of the proximity to the US markets, uh, and low cost of labor and so on and so forth. So, Mexico, Vietnam, India, these are going to be the big places of opportunity, right? But if you look at this, the first graph here on the left, what you will find is that the share of global manufacturing that China has is just huge, 30% plus, and everybody else is very, very low. And the only way, if you think about it structurally over, say, the next decade, is for China to slowly come down, and other countries like India, Vietnam, China, South Korea, Malaysia, Indonesia, all of these countries to slowly pick up, right? So there may not be one big winner, but all of these other countries will continuously, keep taking up market share in terms of manufacturing. Also, we need to remember that China did not become the factory of the world in one day. It took more than 20 years for it to come to this stage, and it is likely to take even longer, or at least the same amount of time for it to uh, for the other countries to pick up steam. Uh, but this is something which is getting sort of accelerated due to the geopolitical tensions that we are seeing between China and the Western world, and I don't see that waning anytime soon. In fact, I would probably assume that because now we are definitely into a Cold War II kind of a scenario between the US and China. This is probably going to get more and more exacerbated. Uh, just continuing on that theme, if you see, what is happening is that there is a lot of negative news coverage coming out from China, whether it is their their slowdown in the economy, whether it is local laws which are against the global companies, whether it is clamped down on Chinese IT companies, or whether it is taking out money. So, if there was a lot of problems, a lot of media coverage when some prominent investors were not able to take money out of China. So, those kinds of things really scare big institutional investors and big investors, because it's your capital is at stake, and you don't want to get stuck in a place where you're not able to take your money out from. And having seen or having gone through the experience of Russia, where a lot of money has did get stuck because of the Russia-Ukraine war, I think a lot of global investors would be thinking twice about making incremental investments into China as of now. The other key thing that we are seeing is a lot of positive media coverage coming in from different global think tanks, rating agencies, brokerages, economic advisory agencies, and so on and so forth. So that is something which is very, very important. So here again, if you see, Harvard Business Review talking about, coming out with an article in July, titled "Does your company have an India strategy?" The global US global investors coming up with a uh, an article, or their main anchor article, saying that why India could be the next global manufacturing hub. Uh, you look at different fund houses coming out and talking specifically about investing in India, and India being the opportunity of the decade and things like that. No, it's I'm not just saying that India will be the biggest opportunity, but definitely unless we make some big mistakes, or unless we there's some major things which go wrong, I think India is well poised to be one of the top two or three destinations for global capital in the next decade, and that I think is going to be a very very important booster for Indian stocks, and we are likely to see much higher levels in the market, and also much more renewed interest in the breadth of companies that are available. So we are likely to see more and more IPOs also happening. So overall, I think Indian markets are likely to be very buoyant over the next few years. I've been saying this for some time, at least probably from the, if I remember, from middle of last year, I've been saying that next year onwards we are likely to be in a very strong bull market, and thankfully I've been right so far. uh, it to me is a more question of probability, right? I mean, it was very evident, and even today I think it is quite evident that India is looking extremely strong amongst all the other countries that we see across the world. Uh, if you see two of the largest cyclical components of the industry in India, which is real estate and autos, have started picking up, and these are news uh, items from this month, from July. Right, India's top eight cities record second highest half yearly housing sales, right? Which is something which we can see all across us. First half year has been really good for real estate. Autos, passenger vehicles see the best ever June performance. So first half of the year, for the first time ever, sales have been more than 3 lakh mark for 6 straight months. That is what the numbers tell us. India has sold over 2 million passenger vehicles in the first half of the year, and for the first time ever. So both passenger vehicles, real estate, and if you look at both these two industries, they have definite downstream repercussions. You know, autos have steel uh, as an input, so it sort of boosts the metal sector. Real estate boosts the bottom of the pyramid tremendously because of construction activity. Income flows directly to a lot of people who are in the low income households, whether in terms of construction workers and things like that. So very very positive from an overall economic perspective, and I think this is one of the reasons why Indian growth has been quite robust, even when we see slowdown across Europe, across the US, and also export oriented businesses in India taking a hit. Uh, Again, at a very broad level, if you see, in my opinion, inflation has moderated to a great deal. Interest rates, I think, have more or less peaked out, and my guess is that we might see rate cuts even as early as April to June, in that period next year. So and most likely we will be cutting, we as an Indian RBI is going to cut rates much before the US Fed and uh, the European Central Bank. So uh, growth is more likely to come back to India faster, uh, purely in terms of looking at interest rates peaking out. Crude, again, which is a very very big determinant of the Indian economy, because obvious reasons, we are the largest importer of crude, uh, and crude prices have been relatively benign, I would say, between this 75, 80 kind of mark for a while, and that augurs well for India, and also the fact that we've been able to uh, buy Russian oil to an extent at lower than market rates. So overall, if the point I wanted to make through all this is that India structurally looks to be in a very, very good sweet spot. Markets are at a high, and that creates panic at times. That creates fear, both in terms of whether we should book profits, or in terms of fear of missing out. So the prescription for all of this is we need to stay invested, stay calm, and in our minds know that this journey is going to be like a roller coaster. It is not going to be a straight line up. There are going to be days when markets will fall, or there will be a couple of weeks when we'll see sharp drawdowns. That is the nature of a bull market, and my guess is we are in a bull market right now, and we are likely to remain in a bull market for a while. And if I look at everything around me, I don't see a reason why India should not do well for the next 2 to 3 years. Uh, so, you know, that is all that I wanted to share with you today. Do send me your feedback and comments, and I hope to get back to you with more of writing, and more of such short or medium short videos, with my thoughts and what some data and analytics. Thank you all for listening, and have a all of you have a great day and a great year ahead.